we're optimistic because our crystal ball is a little clearer than it was in the third quarter last year.
That was the projection of SVB, according to the CEO. But on Friday, March 10, 2023, depositors at Silicon Valley Bank, SVB, woke up to the shocking news that the bank was collapsing. This is the second largest failure in the U.S. bank's history. So what happened? Silicon Valley Bank, SVB, was a commercial bank that primarily served the technology and innovation sector. The bank was founded in 1983 and is headquartered in Santa Clara, California. SVB offered a range of financial services including banking, lending, investment and advisory services to startups, venture capital firms, private equity firms, and other technology-focused businesses. SVB was heavily invested in the technology sector and was committed to supporting the growth of innovative companies. Most of the money that incubated successful technology companies in history, including Apple, Google, and Facebook, among others, went through the bank. In addition to its core banking services, SVB offered a number of other resources to support the technology ecosystem, including market research, networking events, and educational programs. The bank also operated several specialized funds, including the SVB Capital and SVB Leerink Venture Capital funds. This all came to an end on March 10th. Depositors lined up to withdraw their deposits. That led to a liquidity crisis that brought significant and far-reaching effects to the bank. The most immediate effect of the liquidity crisis was a situation known as run on a bank, where depositors rushed to withdraw their funds, fearing that the bank would become insolvent. This led to a rapid depletion of the bank's available cash reserves, further exacerbating the liquidity crisis. Part of the reason that led to the problems the bank faced in the poor startup market since the start of 2023, that meant the bank had faced a sharp decrease in deposits, given it heavily depends on startups and angel investor funds. Another reason that led to the collapse of the SVB is the Fed hiking interest rates.
This is related to the Fed because as interest rates went up and this bank was lending to a lot of startups, this bank simply could not handle it.
Despite SVB getting their money from short-time depositors, they invested much of the money on long-term investments like treasury bonds. During the pandemic, SVB deposits grew tremendously as a result. From 2020, SVB securities portfolio topped $100 billion in less than 1 year. On the other hand, in efforts to curb inflation, the Fed has been hiking interest rates, which meant SVB's old bond prices fell since investors were going for the new high-return bonds offered by the Fed. Panic set in, and customers lined up at SVB Bank to pull out their money. The bank had no choice but to sell their bonds at a discount in order to raise liquidity to satisfy customer demands. The bank announced that it was able to raise $21 billion, but as a result of this sell-off, the bank made an instant loss of $1.8 billion. The bank could not get an investor to cushion the dent. The customer had withdrawn $42 billion, leaving the bank with a negative cash balance of $958 million. SVB CEO Becker was not left behind. He had also withdrawn $2 million that was part of his personal deposits and options. On March 12, 2 days after SVB collapse, another regional bank, Signature Bank, was shuttered. Signature Bank collapse is the third largest collapse of a bank in U.S. history. Signature Bank is heavily related to investments in cryptocurrencies, but the bank downplayed links with the bad crypto environment as the cause of the bank's collapse and cited collapse in confidence with the bank's management. Signature's stock also sank on its last day of public trading before the bank was shuttered. Regulators took over the bank and the FDIC said all deposits will be protected.
Americans can have confidence that the banking system is safe.
The Biden administration blames former President Trump for what is happening. In 2018, then President Trump signed into law a bill that rolled back Dodd-Frank Act, a banking regulation passed in response to the 2008 financial crisis. The Dodd-Frank signed by former President Barack Obama in 2010 is intended to protect consumers against extremely risky financial industry activities like predatory lending that led to the financial crisis of 2007 to 2008.
The legislation I'm signing today rolls back the crippling Dodd-Frank regulations.
In the U.S., deposits up to $250,000 are insured by the FDIC, Federal Deposit Insurance Corporation, but more than 90% of the depositors in SVB, which is 37,000 bank accounts, held more than $250,000. The Fed jumped in to insure these deposits over $250,000 by pledging capital injection to cushion the banking system. This is not over yet. Other banks are in serious crisis. Some are at greater danger than others. One such bank that is at the brink of collapse is the First Republic Bank, based in San Francisco, has 6,000 employees and several high-profile depositors. Its stock fluctuated in the past week and went down to as low as 60%. The bank has been downgraded by S&P and rated as junk. So, what is junk rating and what does it mean? A bank can be rated as junk, or below investment grade, by credit rating agencies when its financial condition is considered weak and risky. A bank's credit rating reflects its ability to repay its debts and indicates the likelihood of default. Credit rating agencies evaluate a bank's financial health by examining its balance sheet, income statement, cash flow statement, management quality, and economic environment. Factors such as high levels of bad debts, low levels of capital, weak liquidity, and poor governance can all contribute to a lower credit rating. When a bank is rated as junk, it means that its creditworthiness is considered to be below investment grade. This means that the bank's ability to repay its debts is deemed to be uncertain, and it may be more difficult for the bank to raise funds through debt or equity offerings. The bank is exploring options to sell it or gain enough liquidity to evade a crisis, but experts feel First Republican Bank may face a bank run like Silicon Valley Bank. According to credit rating agency Moody's, other banks at risk are Zions Bancorporation, Western Alliance Bancorp, Comerica Inc., UMB Financial Corp., and Intrust Financial Corporation. The main risk these banks are facing is uninsured deposits. Martin Gruenberg, the chair of the Federal Deposit Insurance Corporation, FDIC, spoke on March 6 at the Institute of International Bankers, revealing that many U.S. banks were sitting on $620 billion in unrealized losses at the end of 2022. Unrealized losses in banks refer to a decline in the market value of assets that have not yet been sold. Unrealized losses can erode a bank's capital base, which is the amount of money it has available to cover potential losses. This can make the bank less resilient to future shocks and reduce its ability to absorb losses. Unrealized losses can also reduce a bank's profitability, as it may need to set aside more money to cover potential losses on its assets. This can lead to lower returns for shareholders and reduce the bank's ability to pay dividends. As per the last round of filling, big banks record huge losses. Citigroup lost $47 billion, Bank of America lost $21.2 billion, Truist Financial lost $13.6 billion, Wells Fargo lost $13.4 billion, and JP Morgan lost $17.3 billion as a result of unrealized losses. These banks may absorb this shock since they have a huge capital base, but small banks will likely not survive. Experts' opinion is that the Fed is to blame for this crash. Hiking interest rates rendered these banks' old bonds less lucrative, which led to the bond prices plummeting. More events are expected in the coming weeks, as these events will definitely have a cascading effect. The Fed is in a tight spot to avoid the situation getting out of hand. Subscribe to Evening Crypto channel to get news on events as they unfold in the banking sector.